Here is a beginner-level corporate finance manager quiz that covers investment decisions and capital allocation, risk management and compliance, and cost control and expense management. Let's go. Question 1. What is the primary goal of capital allocation? A. Maximizing short-term expenses. B. Allocating resources efficiently for higher returns. C. Reducing the number of employees. And D. Avoiding investment opportunities. Answer: allocating resources efficiently for higher returns. Question 2. Which of the following is a key factor in investment decision-making? A. Employee satisfaction. B. Employee dress code. C. Office space design. And D. Expected rate of return. Answer: expected rate of return. Question 3. What is the term for evaluating investment opportunities using net present value, NPV, internal rate of return, IRR, and payback period? A. Capital budgeting. B. Investment portfolio management. C. Cost reduction planning. And D. Risk avoidance strategy. Answer: capital budgeting. Question 4. A company considering multiple investment projects should prioritize based on A. Employee preferences. B. Project with the lowest cost. C. Highest potential return with acceptable risk. And D. The project requiring the least effort. Answer: highest potential return with acceptable risk. Question 5. Diversification in investment decisions helps a company to A. Increase risk. B. Reduce exposure to a single market or asset class. C. Eliminate all financial risks. And D. Focus only on one type of asset. Answer: reduce exposure to a single market or asset class. Question 6. The time it takes for an investment to recover its initial cost is called A. Capital return period. B. Risk recovery time. C. Profit generation time. And D. Payback period. Answer: payback period. Question 7. The weighted average cost of capital, URCC, is used to A. Determine the minimum return required on an investment. B. Reduce total capital investments. C. Maximize tax obligations. And D. Increase operational expenses. Answer: determine the minimum return required on an investment. Question 8. What is the purpose of financial risk management? A. To eliminate all risks from business operations. B. To identify, assess, and mitigate financial risks. C. To increase tax liabilities. And D. To delay financial reporting. Answer: to identify, assess, and mitigate financial risks. Question 9. Which of the following is not a type of financial risk? A market risk, B. Credit risk, C. Legal risk, and D. Customer satisfaction risk. Answer: customer satisfaction risk. Question 10. What is the main function of compliance in finance? A. Ensuring adherence to financial regulations and legal requirements. B. Increasing company profits. C. Reducing employee salaries. And D. Maximizing advertising costs. Answer: ensuring adherence to financial regulations and legal requirements. Congratulations on completing 10 questions. Let's move ahead. Question 11. Hedging is used as a risk management strategy to A. Increase investment risks, B. Reduce the impact of adverse financial movements, C. Avoid financial reporting, and D. Minimize employee involvement in financial decisions. Answer: reduce the impact of adverse financial movements. Question 12. A company faces liquidity risk when A. It cannot meet short-term financial obligations, B. It has too many investors, C. It has excess cash reserves, and D. It reduces advertising budgets. Answer: it cannot meet short-term financial obligations. Question 13. Credit risk refers to the possibility of A. A decrease in social media engagement, B. An increase in employee turnover, C. A borrower defaulting on a financial obligation, and D. A reduction in office supplies. Answer: a borrower defaulting on a financial obligation. Question 14. What does an internal audit help with? A. Eliminating taxes, B. Reducing employee work hours, C. Increasing stock prices, and D. Evaluating financial processes and identifying compliance gaps. Answer: evaluating financial processes and identifying compliance gaps. Question 15. What is the goal of cost control in corporate finance? A. To track and reduce unnecessary business expenses, B. To increase operational costs, C. To allocate unlimited funds to departments, and D. To avoid financial forecasting. Answer: to track and reduce unnecessary business expenses. Question 16. Break-even analysis helps a company determine A. When profits are maximized, B. When total revenue equals total costs, C. When employee turnover is lowest, and D. When tax liabilities increase. Answer: when total revenue equals total costs. Question 17. A fixed cost is an expense that A. varies based on employee preferences, B. changes with production levels, C. is eliminated when revenue increases, and D. remains constant regardless of production levels. Answer: remains constant regardless of production levels. Question 18. What is an example of a variable cost? A. Rent expenses, B. Raw material costs, C. Office salaries, and D. Loan interest payments. Answer: raw material costs. Question 19. The difference between the actual cost and the budgeted cost of a project is known as A. Cost variance, B. Break-even point, C. Budget surplus, and D. Fixed cost. Answer: cost variance. Question 20. A company that frequently exceeds its budget should A. Ignore financial statements, B. Increase spending to cover excess costs, C. Implement stronger cost control measures, and D. Reduce risk management practices. implement stronger cost control measures. How many did you get right? Comment below and subscribe for more.